to Wednesdays with IGTB. My name is Joshua Cohn and I head the liquidity management business at Intellect IGTB. The title of today's webinar is Black Swans, Preparation and Recovery, looking at the liquidity management and cash management business in this rapidly changing environment. I'm joined today by three experts, each of whom has an extensive background working at some of the largest corporations and financial institutions. So by way of introduction, please welcome Cindy Lowe. Cindy has worked at JP Morgan Chase and Citibank and is currently Global Head of Liquidity Management Solutions at HSBC. Peter Hazu has also worked at HSBC as well as UniCredit and BNY Mellon. And today Peter is the Head of Business Development for Financial Institutions at Microsoft. Christophe Verne spent 15 years with Crédit Agricole Group and has for the last 15 years headed up Capgemini's Payments Solutions business and is the co-author of the World Payments Report. Welcome to you all and thank you for joining this session on Black Swans. I'll go straight into this. So Black Swans was a concept first espoused by Nassim Taleb back in 2007. A Black Swan is an event that is extremely unusual and is defined by three criteria. It is beyond regular expectation, it has an extreme impact, and it has to be able to be normalized after the event. So does COVID-19 qualify as a Black Swan? Well, possibly not, as it does not satisfy the first of these criteria. It is not beyond regular expectation. For instance, in the last few hundred years, we've had global pandemics, such as the Black Death, the plague. 100 years ago, we had the Spanish flu. And of course, today, every government carries out tabletop simulations to understand what a pandemic can do to its economy, to its people, and to society. Perhaps then, COVID-19 is not a true Black Swan event, but we are nonetheless going to investigate now what the impact has been from COVID-19 with particular reference to corporate treasury, cash management and liquidity management. So if I may, I'll turn to my panel now and ask, what were the responses you saw from the market? And do you think that some of the responses were already embedded in corporate governance, in business continuity plans, for instance? Or were these simply reactions? Perhaps, Cindy, if I can ask you first what your experiences were and what you thought about the market responses.
Yeah, sure. Thank you, Joshua. Hello, everyone. Happy to take the first question in terms of how we've seen the market react over the past few months. I think we saw a number of trends over the past few months. First, during the initial phase of the pandemic, we saw an immediate heightened focus from our clients to obtain visibility of their cash positions across geographies. And there were increasing number of clients accessing our online banking platforms, such as liquidity management portal. And many clients access the portal remotely, expectedly, by PC, laptops, mobile applications on telephones and tablets. It was critical for our clients to quickly get a firm handle on their overall liquidity positions and establish the ability to access liquidity they needed when they needed it. There was a lot of focus on treasury teams, obviously the banks as well as like ourselves, to act very quickly to keep the companies going both operationally and financially. And secondly, we saw clients recalibrating their cash portfolios in order to maximize the amount of liquidity available on instant access. So for example, companies draw down on credit facilities and deposit the funds into instant access current accounts. Thirdly, we also saw clients moving cash away from term deposits or notice accounts into overnight products. So the idea is to build up sufficient liquidity buffers to cover short-term payment obligations rather than having the cash tied up in products where it cannot be called upon at a moment's notice. And finally, in order to avoid having cash tied up in locations where it cannot be utilized effectively, we saw an increase in the usage of cash concentration arrangements in order to efficiently move cash balances from certain markets into centralized locations, which maximize the availability of cash internally across our clients' organization. And this was particularly important given the tightening of credit in the market as a consequence of the evolving events that we see.
It sounds like it's quite a structured response. Do you think, therefore, that this was part of the fire drill, that this is an exercise that had been practiced by these corporates before, that they knew pretty much to invoke this particular course of action?
I think it's definitely not a fire drill. Obviously, the pandemic is something that no one has expected and wouldn't even dream of this happening a few months ago. But I think what we've seen is a lot of the corporates, they already have these very useful liquidity management tools in place. And with the banks supporting, they're able to leverage on those tools and be able to react quite quickly, which is something I think just shows that long-term planning really is important, and especially it shows in a case like this.
Peter, do you believe that the reactions we saw were what you would have expected, given what Cindy has just described, or do you think that some of these were a bit unusual?
Yes, Cindy raises a number of points. I think first everybody had to come to terms with a new environment, because suddenly it was not that there were extra workers here or there, it's that everybody was at home. So the first immediate period was to get the workplace together and to get online. The processes of planning for working remotely were all in place. It was more a matter of turning up the volume because suddenly everybody is doing that. But I think in terms of the core issue of the markets and the market reaction, I think today's world is much more real-time and much more data-centric. So the real-time aspects come into play very, very quickly. Traditionally, people would gather around the finance department with spreadsheets and start to pull positions together on spreadsheets. Microsoft loves Excel. I mean, there's nothing wrong with the spreadsheets, but the real-time world really requires a completely different approach, a much more cloud-based technology that enables things to be pulled together in real time. So the first thing is, what's my positions? What are those? And using tools like the ones that Cindy referred to at HSBC is great examples of how to approach that. I would say that the overlay on top of that is a pretty early assessment of counterparty risk. So it's liquidity, but everybody's making calculations about, which part of the economy is going to be affected by this. In fact, all parts of the economy, but really where is my income, who are my counterparties, when are they expected to pay me, how are they going to pay me, and then tracking in very real time, what's being delayed, what's being postponed. And so that goes also into the cash management elements of how one plans for the liquidity and the borrowing needs in order to keep the working capital at the required levels.
Christophe, is liquidity management a bit of a laggard here, given that the market reacted by drawing down a lot of money, as Cindy and Peter describe? It introduced new challenges that perhaps the market was not ready for. Placement of cash, for instance.
Let me build a little bit on what Cindy and Peter have commented. I like the idea of 2 or 3 times in this crisis. First time was a surprise for us, is that day one we were able to continue our work from home, continuing to deliver transformation projects at client and support payment systems. I was even surprised that we were able to access central bank payment system to continue our application management work, which was absolutely impossible to think at maybe a year ago. So as Peter said, the world has changed. We are all now able to work from home, and not just to run our operations, but also to change client, to change the bank and continue. So this was big surprise. Second step, we've heard a lot from clients say after maybe a couple of weeks, we've lost a lot in productivity. We realize that we'll still process a lot of paper checks, especially in France. Maybe 10% of our payments are still processed by checks. We realize that our payment flows are not straight through at all, that there are a lot of data still to be captured and validation and six-size validation. And this is making things a bit more complicated from home. So productivity has dropped, and this is a lesson learned. Third time is that we've been able to launch new projects. The COVID tracker on mobile, but also new projects within our area, payment cash management. Meaning that going further in digitalizing our processes and learning how to use these new tools like Blue Jeans, we are not all familiar with. We still can engage in opportunities. So I agree with the 3 times. And to come back to your question, Joshua, and to answer on real-time payment, of course, real-time is better than previous day or than estimate, but there are still a lot to earn in optimizing instruments and processes on top of moving some to real-time.
Just with a comment, I think that the switch real time, which the industry has been toying with mostly on the consumer side, I think the new reality here is that there's really been 2 years of digital transformation just in the past 2 months. So things really now are rather permanently digitized, and real time plays a big role in that. So I think we're going to be seeing much faster adoption. A lot of the real time systems that are now the rails that are being established or have been established, but much more fundamental use in recognizing that a lot of the payment system batch processing was effectively designed in Victorian times and is now merely an electrified check.
So picking up on Christophe and Peter's comments on real time, I'm going to make a shameless plug here. We've recently published a white paper on real-time liquidity management at Intellect, IGTB, which considers the game-changing opportunities that this will create. Who knows, perhaps we'll do a webcast on real-time liquidity management next month. Anyway, I'll move on quickly and back to the panel. Sticking with liquidity management and thinking about the possible ongoing scenarios. So ongoing scenarios, what are these?
I'm happy to kind of kick off, and it will be very interested to hear Peter and Christophe's view on this as well. I think from our experience working with clients, we saw a lot of focus over the past few months on better visibility, which is something that we touched on earlier, and also the forecasting of the liquidity. How much do I have coming, and how much can I use? And there's a lot of focus on agility of execution, and in some cases, probably more flexible treasury and investment policies as well, which all need to be tweaked in a scenario like this. And I think that as we return to a situation, dare I say, more closely representing normality as we know it, company will probably shift the focus from the current more short-term solutioning to a medium to long-term planning again. And I think if they continue keeping those areas in mind, they will be in much better position to manage the future shock scenarios that like the one we're experiencing. I also think that treasurers will probably be more selective of the banks that they work with, and the flight to quality, which is a scenario that we're experiencing from a bank's perspective, will probably continue, and because of the uncertainty ahead. So I certainly think that companies should partner with trusted banks that can provide a comprehensive range of liquidity services and have the experience in delivering and supporting different cash pooling structures across geographies, which really come in handy in these scenarios. And also have the in-depth knowledge in our clients' markets. And this will probably set a foundation for stronger and longer-term cash liquidity management disciplines and for the long term to come. And I think quickly we talked about, we all touched on working from home. And I think this 9 to 5, 5 day a week kind of work office routine is unlikely to be the thing for the future, in my view. HSBC, for example, have managed to enable over 90% of our staff globally to work from home quite effectively in a very short space of time. And it's something that none of us would have thought of a few months ago. And it's such an extraordinary experience that we will all learn from and use as well to adapt ourselves for the future.
So I think the impact of COVID, we referred to as the sort of the tail end of this, is not really a tail end. There's going to be quite a significant impact, I'm understanding from the market, from a recession point of view. This is going to have big impact on cost savings. I think to Cindy's point about the short-term, less short-termism, I think we saw this also in the last financial crisis 10 years ago. There is a flight to quality initially. There is a more strategic view. As I learned early in my career as a young credit officer, it's really the issue is the principle. It's not, the interest rate that you're making on it. It's really a focus on, am I safe? Is my money safe? So there is a flight to quality, but the economic impact and impairment on different parts of the economy are going to have to make their way through the system. And so I think everybody from a liquidity point of view is going to be very, very carefully monitoring what their needs are, where their money's coming from, and that I think is going to shape a lot of this. Plus the cost savings that's going to have to come into the economy, both to pay for the crisis, but also as balance sheets need to repair themselves.
I would like to add a dimension, and this should speak to Peter, around the proper usage of data. We've had a lot of requests from clients to support on building quickly solutions to help them fine-tune their loan recovery, credit card portfolio management, and anticipate default and losses in coming months. So I'm wondering if we have leveraged as much as we could the data, also from a GAFA perspective, or GAFAM to include Microsoft, to prevent and manage the flow of the crisis. And probably in the future, we'll prepare with solutions building on all this data that is captured to anticipate better than we did. Not just on the flow of the crisis, but also the consequences and the consequences of the consequences.
I think we're going to be seeing a reframing of payments, and liquidity is key in that, but banks have been great processors of payments. There is an enormous flow of payments through the banks, much more than the GAFA. And the insights from that flow have never really been developed by the banks. Everybody's had a big data project, but the reality is that payments are widgets that get processed for a fee. And it's a great business, a great annuity business, but I think one of the great changes in financial services is the arrival of the non-bank competitors in all this. And they are very data-centric, and they have the price-earnings ratios to show that it's really about the data. So I think there's a modernization going on in the thinking at banks. Certainly the C-suite at banks has been hugely aware of this and trying to drive big organizations forward. I think HSBC has been particularly progressive, but also other banks have been quite progressive in taking leadership around the data element, but there's still so much more to do. It is about the data.
We heard that 90% of HSBC's workforce globally is able to access systems and work from home. This sounds like a degree of preparedness, but clearly there's more to be done by banks and by corporates. So if I come to the next slide, how do we minimize the impact of the next Black Swan event? And Peter, can I ask you this? There's a lot of things we have to do. to be lean and mean and fit as an organization and prepared. So what do you think we need to be looking at as a corporate treasurer or as a bank executive?
Riffing on the previous discussion, it is about the data, understanding where the pools are, where the money is, where the principal is, who the counterparties are, and how one manages that in real time. It's essential. The economy moves very quickly, and the impact on balance sheets is quite severe if you're caught wrong-footed. So I would say data is really going to be a central piece, and I think we'll see much more focus on there are many tools, technology tools available around machine learning for understanding, unsupervised machine learning, artificial intelligence. There are many, many tools in the realm of data, and the data is there. I think it's a matter of stitching that together, and I think we'll see much bigger focus in terms of insights for action, for economic development, and so I think data plays a really big role in what the outcome of this is going to be.
We are working with clients in redesigning customer journeys, redesigning workflows, upgrading and simplifying infrastructure to support this move to digital, this accelerated move to digital in all processes, not just payment processes, but also account management, also for banks KYC, reportings, everything that today still requires lots of human interventions.
Yeah, I think in terms of how to help companies minimize the impact, and obviously we're here to serve our clients, and it's very important that we connect with our clients very quickly in this scenario, and also listen to them carefully and try to find a way to help them, an effective solution to help some of the challenges that they face, which is what we have been doing throughout this period. We also share what we see as best practices and what steps our clients' peers are taking, which is also appreciated by some of the clients that we work with. And we have seen, as you talked about, concentration of liquidity with us, like Peter mentioned earlier, absolutely. It's less about how much interest you earn, but who you deposit the cash with. And also we talked about the counterparty risk, and banking certainly, bank certainly is one of the counterparties that clients consider as well. So we try to make our balance sheet available to our clients, and so that they have a safe place to keep the important liquidity buffers and utilize them when required. It is also important that we, continue offering the tools that we talked about and services to help support the demand of our very large client base. We're very well positioned, I would like to say, to offer our clients a range of different options to meet their cash deposit requirements in different countries and currencies. And also there are clients who want to diversify their exposures, as we touched on. And we're also able to offer the off-balance sheet investment options that can also be accessed through portal. So in a time like this, it's even more important that client can self-fund. So to reduce the reliance on the external funding by taking advantage of services like cash pooling. And these options are very helpful for our clients who need to meet a range of objectives, for example, safety and preservation of capital, self-service and investment execution, and also even to be compliant with environmental, social, and governance agenda through the products like green deposits. And so we continue to build upon those liquidity management tools because we can see how much they are benefiting our clients. I think we learned that these services are so important, especially in critical and challenging times like these, and we want to continue to build upon them in order to help our clients, not only through this very unsettling time, but also to support them to grow in the post-COVID-19 world.
Cindy, that's terrific, particularly the impact of cash flow forecasting. The example we talked about earlier in terms of data, I think there's going to be a lot more automation as well. I think traditionally cash flow is opening up today, what's my balance, what am I expecting to pay in the future, what I'm expecting to receive. But with the tools now available from a technology point of view in terms of machine learning and understanding what those flows are likely to be, reaching well into understanding counterparties and flows and impacts to that cash flow will also create the ability for the machine to help treasurers also understand what is the likely maturity? So I don't have to do overnight money anymore. I've got a much better and more predictable future in terms of what I expect my positions to be based upon a lot of data points that I wouldn't normally be able to process, but now with the aid of technology can process. Cash flow forecasting is going to be a critical tool going forward.
Absolutely.
Wow. Well, some really excellent thoughts from the panel there. So what's clear from this conversation is we need an increasingly sophisticated toolkit in cash management and in liquidity management. We heard about self-service, we've heard about automation, better cash flow forecasting, and it's a very big topic there. More focus on real-time liquidity management. I'm looking forward to talking about that soon, and helping in managing counterparty risks. Negative credit migration, clearly it's going to be a challenge. There's also been a really good discussion between the panelists, so I haven't had to interject too much, which is great. And before we take the Q&A session, I should like to thank everybody who's dialed in. Thank you very much for doing so. And my appreciation, of course, to the three co-presenters for presenting on this panel. So thank you, Christophe, thank you, Peter, and thank you, Cindy. Wednesdays with IGTB, every Wednesday we have another topic, and next Wednesday we're looking more at cash flow forecasting and how these products can work. So please join us next Wednesday as well. But once again, thanks everybody for being with us, and wish you all well.